forward the session. Okay. So as we said, the exam is going to be chapter 6, 7, 8, 9, 10, and 13. And we started reviewing the kind of things. There was a question about payroll and payroll taxes related. We talked about the employee portion, where the employee is having withholdings. These are payables, 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 yielding a net payroll to the employee, the cash going out the door. Employer has a match. They have federal unemployment, state unemployment. That's actually an expense of the corporation, but they have a FICA match. They have payroll benefits, pension match, insurance, maybe vacation, holiday pay. Those are related directly to the employer only. So then we had a request, a specific request for a chapter 9, I believe. One of the exercises we're going to review on screen. So I'm going to go into the book and I'll go to the table of contents like you can and will. It's going to ask me, do I want to go where I went before? I say, sure. But that's chapter 10. And by the way, the quiz will be posted today. It'll be due Sunday. It'll help you review for the exam on Monday, but it's chapter 10 quiz that we'll be doing. Back up there. Let's go into chapter 9. And that was exercise, which exercise in chapter 9?
9-8.
9-8. Okay. Let's take a look at that and what we're trying to do. Get out of the way, get that out of the way. Following monthly data: sales salaries, office salaries, federal withholdings, state withholdings, Social Security withheld, Medicare taxes, medical insurance premiums, life insurance premiums, union dues, salaries, subject to unemployment taxes. The employee pays 40% of medical life insurance premium. Prepare a journal entry. Accrued payroll, including employee deduction for July, and then cash payment. And then it has the employer. So just as we talked about, when we're going to go through and figure out what a journal entry looks like, we're going to accrue payroll, which, when does a check get written? Following monthly data, accrues employer taxes related to FICA, FUTA, SUTA, cash payments related to July tax. So this is going to take the form of a wages payable, not a cash credit. So what goes into this? We go ahead and we're going to take care of, and we'll go through the journal entry, and we'll start by putting in the gross expense associated with payroll. So we've got a payroll expense. Could be wage expense, it could be salary expense, but some kind of expense going in the door. What do we have totals? We have sales salaries and office salaries. We have $360,000. And then we have a bunch of payables. We have liabilities that are going on the books. If there were no liabilities, we'd say, oh, thank you very much, employees. Here's your $360,000. Have a good day. But we can't do that. The employee is going to be having to withhold out of their monies federal and state withholding for taxes. The business as a service makes a payable for that. Pay it directly to the government. They do the same thing for pension funds, for union dues, for anything else, insurance, health insurance, life insurance. All of that is a form of a payable which yields a net cash going to the employee. But this time we're going to have a net, not cash, but we're going to have a wages payable. We'll calculate that out in a few minutes. So to get there, we have to deduct a whole bunch of other things. So what do we have to worry about? As we saw in the first whiteboard that we talked about, I have federal withholdings. Fed withholdings payable. I'm going to abbreviate paid. What do we have federal withholdings payable? 90,000. Then I have state income tax. State withholdings payable. Again, not so much the term, as long as you know it's a payable, I'm going to be happy. And we've got state withholdings payable to the tune of $20,000. And then what do we have? We have Social Security and Medicare. I'm going to combine them both just to make it easy. But FICA, Social Security, which is Social Security and Medicare. And I'll just combine the two of those. We've got 22, 320. So you got 22, 27, 540. 27.54K. I'm going to ask somebody to take out a calculator in a minute to calculate the wages payable for me, and I appreciate that. Life insurance payable. What I got for that, I've got 4K. And then I have union dues payable. What I got there, 1K. Now we've got salaries subject, let's see, I'm sorry. We only need to take 40% of the medical and life insurance. And we've got life insurance payable for, I'm gonna put that medical insurance payable, I'm gonna recalculate that. Medical. I'm not sure what's going on here. There's something I just clear on the screen. So, medical insurance payable. And we had 7,000. I'm going to correct those numbers. We're only doing 40% for the employer. So I'm going to have to change those numbers. And what's 40% of 7? What's 4 times 7? Probably sounds like 2.8 to me. And what is 40% of 4? Sounds like 1.6 to me. Probably is going to write over this, kind of messy. Okay, so 1.6, 2.8. How this input selected form got on the screen. I don't know if you see that, but I do, and I don't want to. There we go. Okay, so anything else we have to deduct? And salaries subject to unemployment tax is $50,000. So that's going to be a calculation that we make for the employers, 5.4%, of which state are 5.4 and federal is 0.6. So we have a total of 6%. We'll worry about the employer's portion in a minute. So does everybody see how we're getting all these payables out the door? And how the wages payable, bottom line, we're going to have to calculate whatever the remaining balance is here. So if someone can take the 360, subtract the 90, the 20, the 27.54, the 2.8, the 1.6, and the 1, and give me a number for the wages payable, please. 10, 30, 143,
213.06.
Thank you very much. Sounds about right. 213.06. So we've got a payable obligation that shows up. All of this is showing up as a payable. We get to 20,000 there too. Thank you. 90,000. And this payroll expense totals 360. When we write the check, we're going to clear the payable. So we're going to have wages payable goes to 0. And we're going to have the cash. We're going to write the checks to the employees. When we pay it. Had we paid it right away on the same day and recorded it all together, we'd have no wages payable. We just have cash going out the door for $213,000 based on a $360,000 payroll. Eventually, the employer is going to take a debit to the 90,000 on federal withholding payable, and a credit to 90,000 cash. They're going to pay the bill. Debit to the state, 20, credit cash. Debit FICA, 27.54, credit cash. Debit medical insurance, 2.8K, credit cash. Same thing for life insurance, same thing for union dues. All that's paid eventually. But those are not expenses of the employer. They're expenses of you and me. They come out of our pocket. If we didn't have Medicare or FICA, we'd get a raise. If we didn't pay life insurance, so we chose a lower amount for life insurance, we'd get a raise. If we didn't have a union dues to pay, we'd get a raise. All those taxes are our money. That, which is why I sometimes talk about, aren't you excited to get a $1,500 refund at the end of the year when you file your taxes? What you really should be looking at is you paid $9,000 in taxes and you're getting $1,500 back, so you only pay $7,500. Congratulations. You did pay $7,500. Not you get, the government's not giving you back $1,500 of their money. They're giving you $1,500 of your own money that you overpaid in taxes. So that, just want to understand how this tax system works. I hate getting refunds. Why? Because I'm giving the government an interest-free loan on my money. It's my money I paid in, and they're giving me money back. I don't mind paying for services. I don't mind paying taxes, frankly, because I get a lot of value for those taxes. We get roadways, we get services, whether it's fire, police, we get you guys in getting into school, get subsidized. Those are all things that are value, and I'm willing to put my money, or let the government put my money into it. They also put money into things I disagree with, but that's democracy. Thank you very much. Any questions on the employee portion of all this stuff? Is that pretty clear? Okay. So now let's look at the employer portion. Okay. So now the employers will have direct expenses. And we're going to look at the same kind of thing here. So we're going to look at our same payroll. Only this time we're going to record an expense, not just wage expense, but an expense for the employer. So we're going to have a big ticket up here. We're going to plug that number in a little while. So I'm going to have payroll related expenses. This is the employer stuff. Okay. And when we do that, we're going to total up a whole bunch of things. Okay. So what kind of payable do we generate here? Well, we're going to have federal withholding payable that we withheld from the employee. Okay. I take it back. We don't, that's already accounted for. We don't have to put the federal withholdings on here. I apologize. We do have to put the state Medicare match. So we have federal, FICA, Medicare match. Get that thing out of here. Okay, and it doesn't like the slash I put. We have a match. It's not going to let me do it. I've got another utility on here that's kind of a Medicare payable. That is our match that we have to put in there. And so we're going to match, not the federal, the 90. We're not going to match the 20. We are going to match the 22,000 and the 5,000. So we got 27,540. And additionally, we don't have to worry about, well, we do have to worry about medical insurance. Med insurance, life insurance, payable. And again, we're paying 60% of that. So we've got medical of 7 and life, I'm just going to bind them here, 11. And if I take 11 times 6, I get 6,600, 6.6K. And then I don't have to worry about union dues because I'm not matching those, but I do have to worry about unemployment. We got FUTA payable and SUTA payable. So what do I have for FUTA? Federal unemployment came in at 0.6% and state came in at 5.4%. So our federal unemployment, we have 650,000, 6%, 60 is 30,000. So I got $3,000 in federal unemployment. Okay, so this is at 0.6%. And then I have my SUTA, which was 5.4%. So that would be 2.7, 2.74. Is that? No, that's what's 5%. So 50% is 25, 2500. Did I get that right? 0.6. I think I'm off a decimal here. That should be 0.3K. This is at 5.4%. They'll tell you whatever the problem is. So what's 5, 20, 25, 2.7K maybe? Check my math, make sure we're on the same page, make sure it's right. Okay. So I'm gonna plug my payroll. Now, sometimes you might separate that out. FUTA expense, SUTA expense, benefits, payroll. I just put it all in payroll related expenses, but you might see it isolated. But realize that you're debiting the expense. No surprise. Can somebody total up that mess of numbers too? 27, 32, 33, 35, 36, 37.14 sound right? So for that payroll of $360,000, we've got another $37,000, 10% of that roughly, that's going to be employer expenses, which is why they rather have you as a subcontractor than an employee. A subcontractor doesn't have benefits, doesn't have vacations. They're responsible for their own, but there are very strict laws about contractors versus employees. I can't just hire you and say you're a contractor unless you've got other clients you serve, and I'm not dictating how you do your job. I have less controls over contractors. But I have some very definite tax benefits to having contractors versus employees. If I can contract things out to a part-time service to clean my offices, to mow the lawns, rather than doing it in-house, I don't have to hire employees to do that. There are definitely some cost savings potentially associated with that. Are we on the same page? Are we making sense? And then the cash payment eventually will clear all of these items. We're going to write the check. And we're going to have the ability with the cash payment of all this stuff, we'll debit the payable and credit the cash, the same way we did it for all the other payables we had from the employee side. But this is all directly related to the employer, not the employee. Good question. Thank you for asking. That's a pretty powerful thing to look at. And hopefully it helps you understand your own personal paycheck. Why did I make $2,000 and only get to pocket $1,300? It's a killer. Wouldn't you rather have that $700 in your pocket? I would. I know where I want to put my money. I know where I want to donate it. I want to volunteer it. I want to spend it. But the same way that, and let me make a comment about here on sales tax. Sales tax is collected by the seller, but is not revenue to the seller. It's a payable, it's a liability, it's an obligation to pay the government for monies that were collected on behalf of the customer. But I will tell you, the government would have a heck of a time going after every customer to collect all that sales tax. So they find it easier for the company, the corporations, for Walmart and Target to collect your sales tax and send it in than to go after every individual for buying all this stuff. And I'll bring up one more point. If you buy stuff out of state to get out of sales tax, there's something called sales and use tax. And if you buy stuff from out of state and you don't pay taxes on it, the state of South Carolina is saying you're still consuming it in the state of South Carolina. You need to pay a use tax on it. So as a company, you're still on the hook for paying taxes. So even if you buy something tax-free out of state and have it shipped to you, you are liable to pay a use tax as a business. You say, wait a minute, I thought that's tax-free. That's why that's why I got it out of state. I got 8% savings by not having to pay taxes. Nice trick. Except the state's onto you. Say you need to file a sales and use tax form. So, yep, you'll pay your sales tax, but what else did you buy that you didn't pay taxes on? Hand over some extra money on that. Good question. Hopefully that clarifies things a little bit and makes things a little bit more understandable.
Can you go over how to record the discount bonds and the premium bonds again?
Of course. Do you have a specific exercise or problem in mind that you'd like to review? Because I like using those because that's something you can go back and study. I can talk all day on this stuff, but if you can find something in chapter 10, if you go in the book, and anybody can do this, find a specific exercise you'd like to talk about. And we can go directly, it could be a brief exercise, could be a question, could be a problem, it could be an exercise. I prefer to review those because there's the numbers that you can see printed a lot more easily than me making up numbers. And then you'll understand that's the kind of quiz questions, because I tap questions that relate to the exercises that are in the book. So I hate to answer a question with a question. I don't mind saying it depends, but I do want to get to you the answers so that you can understand from a printed problem. It makes it easier to read and I think get a bigger picture. So if you don't mind, I mean, I'll talk about premiums and discounts as you search out a problem, but that's going to be, I'll just do a general conversation like I did with payroll. So if we go into, I'm gonna clear the screen. So if we want to go in and understand bonds, premiums, and discounts, we're gonna have a bond payable as a liability, long-term liability. And we may have a premium which is a credit balance, or we may have a discount, which is a contra liability account as a debit balance. So what's going to happen? We sell a bond for 10 million, or, oh, I'm sorry, we sell a $10 million bond for 11 million. And you'll need to be able to answer the next question I ask. If I tell you this is at 9% stated rate, you should be able to tell me, is the market rate greater or less than 9%?
Less than.
I get a vote for the market rate is less than 9%. So what will make, is this bond more desirable? So I've got, okay, actually go ahead in the chat. Tell me more or less. Just go ahead and chat. Everybody answer. Here's my attendance question. More or less, the market rate greater than 9% or less than 9%? And the way to also think about it, would I be willing to pay more for a 9% bond if the market rate was 8? Or would I be willing to pay more for a 9% bond if the market rate was 10? So I've got a mixture of more and less here. Most are saying less. Some are saying more. Okay. So if the market rate, as interest rates go up, price goes down. I'm going to say market. So in this case, if the market interest rate is higher, the price of this bond is going to be less. But we said the price of this bond is higher, so the interest rate has to be less. So think about it. We just asked the question, would you want to have a 9% bond or an 8% bond? Oh, I want a 9% bond. As a matter of fact, if the price is the same, I'd rather get a 9% bond than an 8% bond. So the stated rate's 9%. But the market rate of interest, actually, let me review this. So if we're going through and we're looking at that 8%, let's say 8% versus 10%. Obviously, you'd rather have a 10% than a 9. You're willing to pay more for that 10% bond. If the market rate of interest is 8 and you got a 9% bond, actually, am I confusing the issue here? I think I'm making it more complex than it is. So if we have a $10 million bond, we sell it for $1 million premium, people are paying an extra $1 million to get this bond. It's because the market rate itself is lower, is less. So they find this bond more valuable. So they're going to pay a higher price to get the 9% return and make an effective interest, an 8% effective. So when the market rate is greater, the price of the bond is down. When the market rate is less, the price is higher. So market rate is going to be less, and it raises the price of the bond. That 9% bond is more valuable than an 8% bond, so someone's going to have to pay more for it. The price would go up for a discount. So what's going to get me to purchase a 10% bond if I'm only paying 9%? If you're paying 9%, I'd rather get 10%. I have to lower the price of this bond for an effective yield for a discount, and I effective 10% yield. So I have to lower the price of that $10 million bond maybe to 9.5 million to make it a 10% effective payout. So you want to be comfortable understanding when a premium is issued, when a discount. And in this case, I'm going to have, I'll just write it in here. I'm going to have a 10 million bond payable. I'm going to have a premium of 1 million, and I'm going to get cash of 11 million. Debit my cash, credit my bond payable, credit my premium. And if I told you this was a 10-year bond, I would have, and I told you straight line amortization, I would be taking out $1 million, I'd get $100,000 a year. Or $50,000 every 6 months, because bonds are paid every 6 months. So what would the journal entry look like for this bond on my first payment? Well, I said this was a 9% bond, right? Let's see, we'll put it out here. 10-year, 9%. Semi-annual interest. $10 million. So as we said, I got cash of 11 million. And I have a bonds payable, 10 million. I'm not hearing a problem yet. I hope you found one. Or this might answer it. Premium on bonds payable, 1 million. Okay. Now my first interest payment. How much cash am I going to put out the door? Somebody calculate that for me, please. Well, what's 9% of $10 million? Well, what's 10% of 10 million? Oh, that's easy. That's $1 million. What's 9%? Oh, that'd be $900,000. That's a year, $900,000 a year. What would 6 months of interest be? Can somebody give me a number? You're gonna have to do it on a test. You may as well do it now.
450,000.
450,000. Ding, ding, ding. We have a winner. Thank you. Now, how much of that is interest expense? And how much of that is an amortization of my bond premium? So I'm going to debit my premium, where I credited it here for $1 million, but every year I'm going to take away how much? Oh, well, $100,000 a year, or $50,000 every 6 months. I already calculated that for you, didn't I? I've got $50,000 going out as my amortization of premium. Somebody tell me what my expense is going to be? Somebody else besides James who answered before? Richard, what do you think? You're next on my screen. What's my interest expense?
It's not 400,000.
Say again?
400K.
We got a winner. Ding, ding, ding. 400,000. Thank you. We're in balance. Life is good. We stay in balance. As a matter of fact, and I told you I wasn't going to test you on the effective interest method, even though it's more popularly used. I want you to just, if you understand the concept and you've got to feel and understand the straight line method, you're going to be in good shape. And you're going to say, oh, I'm going to make every 6 months the same journal entry. And eventually this $1 million is now going to be 950, then 900, then 850, then 800, and eventually it'll go down to 0. I'm going to make 20 of these journal entries. It's going to clear my premium. And then I'm going to write the check. How do I write the check? I say, oh, my bonds payable is sitting at $10 million. I got to clear that. And there goes the cash payment. I got to write out and write the check for $10 million to pay it off. That's my final entry. Clear the books, get rid of the bond. Municipalities and governments do bonds all the time. Corporations do bonds all the time. Apple has bonds. Tesla has bonds. Everybody, most corporations have bonds out there. Some form of debt, some form of liability, some form of obligation that they have to pay interest on, and then they have to pay the principal back. And we've got two cash flows. We've got this cash flow that we're going to calculate to get the bond value. So we're going to look at our cash flows. We got that cash flow once, and we get this cash flow 20 times. You add the discounted cash flow, and that's the price of our bond. That's how you determine that a $10 million bond is going to cost more or less than 10 million. And remember, we're going to use the market rate calculate price. Use stated rate calculate cash paid for interest. So that $450,000 is based on the 9%. The other calculations of the price of the bond are based on the 8% or whatever the rate is, whatever the market rate is. The only time we use a stated rate is to calculate how much we have to write the check for. Because that's a contractual obligation. We're saying we promise you 9% on this $10 million. And 10 years from now, we'll pay you $10 million. But today, the amount of money I want for this bond will depend on what the market rate is all about. Making sense? Okay, so did you come up with a problem or a specific example in the exercises, or does that kind of cover the big picture of what we're trying to do with bonds?
It starts with 10-5 and then 10-6, or one's on discount, one's on premium.
Is that exercise or problem or brief exercise? Just to confirm.
That is an exercise.
Exercise 10-5 and 10-6?
Yes.
Okay, so let's go into chapter 10. Let's clear out 9. We'll go on to 10. We'll go on to exercises. Okay. So we got straight line, 6%, 4-year bonds, par value 200, semi-annual interest. Use the bond amortization table, prepare journal entry to record the issuance of bonds, first interest payment June 30, and select interest payment. So the question is here is, what's the price of the bond? And we need to calculate the issue of the bonds on January 1. Oh, here we go. Well, they tell us. For your bonds, semi-annual, use the following bond amortization table. Prepare journal entries to record the issuance of the bond. Okay. So the first payment, June 30th, second payment. So let's look at that. How much cash did we get on January 1? Anybody? You look at this table, you should be able to tell me what the cash received is on January 1. How much cash did I get? Let's give, I'm going to start calling on people. I'll put you on the spot. That's how I make a living. Stan, what you got? How much cash did I pay for this bond? Or did I receive when I issued this bond? I know you're there. $200,000 bond. I didn't get $200,000 cash, did I?
No.
So, and did I get more or less than 200,000? Well, there's a discount there. Did I get more or less?
Less.
Less. How much did I get?
Help anybody? Somebody?
Throw a number. It's one of those 6 numbers. I'll give you that hint. How much did
One
I?
of the. Okay, let's go with 188. That one. 218.
Okay, that's one of the numbers. You had a 1 in 6 chance, and not quite right.
All right.
What was the date we issued this thing?
Is it 186,534?
186,534. Thank you very much. Good answer. So we
That
did
one.
this on January 1st, which is why on a good journal entry you put a date, right? We issued on January 1st. How much is the bond payable? Okay. Grace, give me a shot. What is the actual amount of the bond payable that's due here?
Wouldn't it just be the 200,000?
It sure would be just the 200,000. Perfect answer. Thank you. So I am off by a certain amount, sum here. What am I off by? Well, what do we call this? Is this a discount or a premium?
Discount,
Want to take a shot?
discount.
We got a discount. We're getting less. It's a contra liability account, discount on bonds payable. And Gab, you want to give me a number? You may not want to, but could you please give me a number? What do I got for a discount? Are you there, Gabby? You just tell me if you're there or not. That would be helpful. I want to make sure to give you credit for being here or not for not being here. Eva, any idea what we're doing for the amount for discount? Are you there, Eva?
Would it not just be the 13,466?
You bet. It better be the 13. Thank you for helping out. 466. All right, that's what we issued. We issued at a discount. We didn't get all the money we wanted. The market rate of interest must be higher than the rate that with the 6% that we promised. They must be able to get 7% somewhere else. So in order for us to sell our 6% bonds, we had to sell it cheaper. We had to give a discount. Okay. Does that make sense? Now we want to look at the first interest payment. I'm going to roll that down the bottom. Okay, so I got a first interest payment. I went ahead and I can't debit my discount anymore. I have to credit to offset it. So I've got interest expense. I'm not going to put my discount here as a debit, but I better put my discount here. I'm going to start eliminating my discount. And I'm going to write the check. So, Keolia, what is the amount I write the check for? Every 6 months, I'm writing a check. How much do I write the check for? Keolia Lee, please, come on down. Thank you for unmuting.
Is it the
Actually, tell me how you calculate it. Let's just do it out loud. Would it be what? How would I calculate the amount I write the interest payment for, the cash?
take the rate
Okay, the 6%,
and then multiply it by the 200,000?
200,000. So that gives me, if I do the math, not 120,000, but 12,000. So that's 12,000 a year. And what do I do to that 12,000?
Would you divide that by I'm trying to find, what are we trying to find again?
So we're trying to find out the cash payment. You can see it on screen.
All right.
I got 6% 4-year bonds. I pay the interest twice a year, semi-annual interest.
So
And
you divide the 12,000.
6%, 200,000. We had 12,000 out of that. And what do I have to do to that 12,000?
Would you divide it by 2? Since it's
Divide by 2. What's 12,000 divided by 2?
6,000?
Ding, ding, ding. We got a winner. Thank you. Well played. Well said. So we got $6,000 to write the check for. If the bonds were issued at par, if the market rate was 6% and the stated rate was 6%, there would be no discount, there'd be no premium, and the interest expense would be $6,000. But we can't do that. That's too easy. I'm not going to make it that easy for you either. But that's not the way businesses run. So we need to figure out the change in the discount. Can somebody see how they can calculate the change in the discount given the numbers on screen? Danny, you want to take a shot at it? How would I calculate the discount based on the numbers I see on screen? Are you there, Danny? Please come off mute. Give me a sign. Thank you.
Yeah, I'm sorry.
That's okay. No need to be. So how do I go about calculating the discount that we amortized from this one payment based on the numbers on screen? Any idea? Well, did we see the unamortized discount change?
I'm an accountant. Yeah.
So how much did the discount change? Any ideas? Danny, you want to take a shot? What numbers would you look at to figure out the change in discount? Let's go with James Davis. You want to give it a try? How would I calculate the discount amount based on what you see on screen? You can come off mute if you don't mind. All the numbers are there that you need to figure it out.
Calculate 186, 534, 13.466.
186 from 188. The change. Is that what you just said?
Yep.
Okay, have you got a number for me? I think you're on track. I think you're onto something though. Thousand something.
I got a fairly large number.
Okay. The way I did it, by the way, is I took the 13,466 and subtracted the 11,782. That's the same change. The carrying value change, the discount change. I had $118, 1,118. So 118 and 466 is 584. That sounds about right. Anybody have a different number?
Is it 1,684?
I think you might be right.
I believe he's right.
684.
What's that?
1,684.
Thank you. See what I do when I put numbers in my head? Thank you for catching that. So we're at 1684. Okay. So let's go one step further. If I wanted to ask you, Greg, want to take a shot? What's my total interest expense? Greg Bailey, come on down.
Let's see. So you would find the difference between cash and discount on bonds payable, and then that would be the interest expense, right?
That number for me?
Yeah, I'm calculating it right now.
Perfect. Thank you.
Should be 4,316.
4316. Does this journal entry balance? My debits equal my credits.
Yes, it does.
4316 equals 1684 plus 6,000?
No, it should be 7,684, right?
Thank
I
you.
should add. Yeah, I took the difference instead of adding.
Yeah, you took the difference out of adding, but caught it. Why'd you catch it? Because right now you're looking at this saying, oh, I need to balance. This is a journal entry. My debits have to equal my credits. So my interest expense is higher when I issue bonds at a discount because I'm paying an effective interest rate that's higher because the market rate of interest is higher. And you do need to combine that. So
Yes, sir.
shape. Does that help at all? I know we're out of time.
Yeah.
If you guys
Yeah,
want to move on, I mean, you're welcome to sit through round 2. I can go through the exercise 10-6 if you like as well. But I want to make sure you're comfortable understanding these discounts and premiums because this is the real world. Bonds are never issued at par. You got a family member that doesn't care
So this
based on market
discount
rates.
on bonds premium is a credit.
You have the bond premium as a credit, and then the amortization would be a debit. It would be the opposite, right? And
All
our
right.
expense would be smaller than the cash payment. So had these bonds been issued at premium, we'd have a credit balance in the premium account. We'd have to keep debiting it to amortize it. So we debit the premium, we'd have interest expense as a debit, and we'd have cash as a credit. So yes, a premium would be the exact opposite of what we're doing right here. And the carrying value would be more than $200,000, not less than $200,000.
Okay.
Good to go. Okay. Would you like to see these posted on Blackboard?
Yes, please.
Give me a minute. Okay, I'll get this posted. We did exercise 10-5. What was the exercise in chapter 9 that we did? Does anybody recall?
I think it was 9-8.
9-8.
Exercise 9-8. Okay. I'll make sure that gets posted. I'm going to stop the recording here and we'll get ready for the next class. You're welcome to hang on and you're welcome to be a part, but I will go ahead and pause the recording here.